Hi, welcome to Structured Finance Conversations. My name is Paula Moreno, Head of Structured Finance for the Americas, and today I'm joined by Bob Vrchota, Head of North American CMBS at Fitch Ratings, to discuss 2025 issuance, performance trends, rating transitions, and what's next for the sector. So let's get started. Bob, could we maybe start with the market backdrop? Issuance has surprised to the upside this year. What's driving the rebound?
Yeah, thank you, Paula. If we take a look back at last year, 2024, volume was pretty strong at about $115 billion, not including the GSE, Freddie, Fannie type product. And that momentum really carried forward into 2025. January, February issuance was very strong, almost 25% ahead of pace. A little bit of a hiccup right around April when tariffs were announced, but then picked right back up in May. So that pace has continued. We're continuing to see pretty strong pipeline and momentum. And if you carry that forward, we're looking at maybe 140, 150 billion in issuance volume by year end.
And Bob, how much of this pickup is refinancing versus acquisition or recap driven?
A good question. So the activity this year has primarily been refi activity. It's a lot of legacy loans, 10-year type loans coming off of pretty low mortgage rates, 4.5%, refinancing into the higher rate environments, 6.5%, 7%, and borrowers have just come to accept the higher rates. So refi activity is actually about 80, 90% of all activity these days. It used to be maybe 70% of activity, so we're seeing definitely a lot of refi activity. Sales, acquisitions are still not picked up to pre-pandemic type levels.
Bob, and what are you seeing across conduit, SASB, and CRE CLO shelves? Are specific property types or geographies dominating deal flow?
Yeah, deal flow, I'll break it into sort of three components. So first we have conduits, which are your typical 10-year fixed rate product. That's been pretty steady at right about 30 billion in issuance for the last 2 or 3 years. That used to be 45, 50 billion 10 years ago. So it's tailed off, but it's pretty steady. And we expect that to continue. CRE CLOs is probably the one area that's grown the most. If we look at activity last year, it was about 9 billion in issuance. This year we're already at 21 billion, so we may even almost triple the volume of CRE CLO issuance. And then the last sort of major component is SASBs, or single borrower deals. Single borrower deals were about 70 billion in issuance last year. We're on pace to probably be close to 75 billion, so a little bit of an uptick there as well. Now by property type, because we're seeing a lot of CRE CLOs, those are primarily multifam, so we're seeing a lot of multifam type deals. So 80% of CRE CLOs are multifam exposure. And I'd say the last sector that sort of picked up geographically is actually New York City. So we're seeing a lot more single borrower SASB New York City office transactions. There were only 4 single borrower SASB office deals last year. We've already had a dozen this year. So that sector has definitely come back.
Thank you, Bob. I think that's the perfect segue for us to move from issuance to what's really happening inside our rated transactions. We keep hearing about stresses in CRE, right? Where do CMBS delinquencies stand today, and what are your expectations through year end and into 2026?
Yeah, it's interesting. So we started the year with a delinquency rate, this is 60 plus day delinquency, so 60, 90 foreclosure REO, at just under 3%, so 2.98%. Today, sort of 3 quarters into the year, we're sitting at 3%. So it's almost exactly the same, but what's been happening is it kind of goes up and down a little bit each month just based on large transfers or large delinquencies that occur, but then there's resolutions. The other thing that's happened is the issuance activity is sort of the denominator of that equation. Mm-hmm. With strong issuance, it kind of buoys the number, if you will, or supports the sort of stable delinquency number.
And which sectors are driving delinquencies? Is it still office-led, or is it broadening to any other sectors?
Yes, it's still office. So pretty much all of the other property types, commercial property types, have rallied off of their pandemic high delinquency numbers. The one exception is office. If we looked at office delinquencies just 2 years ago in 2023, they were sitting at 1.3%, and now they're at 8%. So every quarter for basically the last 2.5 years, they've continued to increase. And our forecast is still, unfortunately, for them to go up a little bit higher. We have office delinquencies about 8.5% by year end 25. And looking forward, based on maturing volumes and stress tests we do, we see office delinquencies could be as high as about 10.5%. So there's still a little ways to go on the office front.
And how are delinquencies differing between conduit and SASBs?
Yeah, interesting question. So conduit, we cover pretty much the entire universe. Our conduit delinquency rate for all property types is about 5%. That's been holding pretty steady year over year. The SASB is interesting. So we've been very selective. Fitch has been very selective in which SASBs we've rated over time, over the last 10, 15 years. And our performance has really outpaced the market. So I'll answer it from the perspective of CMBS. Fitch has rated, SASB delinquency rate is actually 0% right now. There are 0 loans that are delinquent. Now, there are a few on the SASB front that are in special servicing, but they're still getting paid current from actual performance. So they're just in for mods or extensions. If we look at the special servicing rate, we have on any given month, say 5 single borrower deals or SASBs that are in special servicing. That's about 4% of our rated book. The non-Fitch rated single borrower market is 14%. So clearly a big difference. It's almost 3 to 4 times worse than the Fitch rated book. So I think we've been pretty strategic and selective in rating SASBs, and it's paid off for us.
Okay, and how concerned should we be about the 2025-27 maturity wall? Are extensions and mods trends easing the pressure, or is refi risk still elevated?
Yeah, I mean, refi risk is still elevated in the sense that mortgage rates are still higher. So when we look at the 25, 26, even 27 vintages, forthcoming maturities, the weighted average mortgage rates on those loans are still 4.5%. So they're going to have to most likely refi into an environment of 6, 6.5, or 7% mortgage rates. So the risk is still going to be there. I will say, though, the volume, it's not really a maturity wall per se. It's a pretty steady flow. We had about $36 billion of conduit loans maturing in 25 coming into the year. 2026, we have $42 billion, so it's a little bit higher, but it's actually fewer loans by count. So it's actually just bigger loans that are maturing next year. And then fast forward to 27, we actually back down to $35 billion. So it's not a wall, it's sort of a steady flow of maturities over the next few years.
And we can't talk about real estate without talking about values. What are you seeing in terms of value declines for all property types? And have we seen any signs of stabilization?
Yeah, good question. Values really peaked out for commercial real estate in the U.S. in the second quarter of 2022. That's when interest rates were at their lowest, and yields at their lowest as well. So since then, values have come down for all property types on average about 17.5%. But it varies, pretty significantly by property type. So multifam is down about 19%. Industrials are down about 15%. Retail is down only 10%, but the big outlier is office. Office is down 37%. Now, there is a little bit of stabilization. So we have had actually flat values for the last 6 to 9 months. So that's a good sign. There's price discovery, stabilization helps with refinance activity. Borrowers have some confidence in where the values are. So we are seeing a little bit of stabilization. And we may actually see a 3 to 5% increase in value this year by the end of 2025. So there is a little bit of positive momentum there.
So considering all these pressures, let's talk about ratings. With the commercial real estate stress, especially in office, what are you seeing in rating transitions across CMBS? And how do downgrades, affirmations, and outlook changes compare to last year?
Yeah, rating activity is interesting, and I'll break it into sort of 2 buckets again. So again, we talked a little bit about our SASB book or our single borrower book. Because we've had very few delinquencies and very few transfers to special servicing, the rating activity has been pretty benign. We have 96% of all ratings at all the categories, AAA, AA, single A on down, have either been affirmed, upgraded, or paid in full, which leaves about 4% that have had some negative rating movement. These would be some of the office SASBs that maybe struggled to refi. But the rating actions have been pretty modest, down 2 to 3 notches on average. So rating activity has been pretty modest on the SASB side. More broadly on the conduit side, looking at 2024 compared to 2025, for example, it's actually been pretty stable, or consistent, I should say, right? So we had about 81% affirmations this year, year to date, on the conduit front versus 82% last year. So it's almost the same. There's a little more downgrades. We've had 12% of our classes downgraded this year versus 10% last year. But it's a little bit trying to front run and be forward looking on some of the stresses and sensitivities that we're applying. I do suspect by the end of the year and into next year, the rates should moderate.
And are these actions concentrated in specific vintages or deal types in the conduit world?
Yeah, absolutely. So as we had touched on earlier, it's office, right? Office with the high value declines, the increasing delinquencies are really the deals that are driving the downgrades. And specifically pre-pandemic. So anything from 2019 and earlier on the vintage front tend to have more downgrade activity than 2020 to present. 2020 to present, the rating activity has been pretty, again, benign. 3 to 4% of classes have been downgraded. usually for idiosyncratic risks related to certain borrower issues, not necessarily office-driven.
And Bob, what indicators are you watching more closely for further actions?
Yeah, further actions at this point, we've tried to put signaling in place with rating outlooks, and that'll kind of give you an idea as to which classes, which deals we see risks may, come up at some point. And what we're looking is for performance, right? So if we see more transfers to special servicing, we see more updated appraisals come in with big value declines. If we see a lot of loans where we have borrowers with issues and or tenants that are rolling at some of the property level metrics, we may have to take actions on those, but it's really going to be performance based.
Thank you, Bob. Let's now move into what's new or changing in the market. What new developments now stand out this year? Any new asset classes gaining momentum?
Yeah, a lot. As we had touched on earlier, I think the single borrower office market is returning. Again, in New York City, we've had more than a dozen single borrower office deals, generally higher quality trophy type assets. I think that momentum is going to continue to move forward. Investors, issuers are getting more comfortable with the office exposure. We've also seen, again, the growth in CRE CLOs, which we hope will persist. And then we're starting to see more inquiries and interest in data centers in particular.
Yeah, you recently actually released the new criteria. Can you maybe
That's
walk
right.
us through changes in what you're expecting there?
Yeah, on the criteria front, we did put out an updated criteria, which is meant to really capture in a cohesive view both CMBS style structures and ABS style structures on the data center front. So it's one sort of uniform approach to rating and looking at the risks related to data centers. And it's actually played into our favor in the sense that we've rated several data center transactions this year, both on the CMBS front and on the ABS front. And then lastly, I'd say, we're starting to see inquiries also on feeder funds, private credit front, so a lot of sort of creative financing of commercial real estate is coming down the pipeline.
There's one other topic in CRE, which is servicing. How are servicers approaching workouts? Are they doing something different when compared to other cycles?
Yeah, I think in this cycle, you're definitely seeing servicers take a very pragmatic approach to say, do we want to foreclose and own this asset, reposition it, sell it ourselves? Or should we, if we have an interested borrower who's injecting equity, who's staying committed, should we continue to work with that borrower, maybe extend the loan, modify it, make the borrower put up a little equity or reserves and try to work it out that way. So I think you're seeing servicers try to, if they can, keep in place the existing borrower if they're committed, and or if there's an assumption, bring in a new borrower with the existing financing in place, which is typically at a pretty low mortgage rate. So a little more creative on that front than maybe in the past.
Thank you, Bob. Let's maybe close with a forward-looking view. Can you share with us the CRE outlook by property type and maybe compare how those outlooks have evolved post-pandemic?
Sure, yeah, outlooks by property type. So we have, I'll go through a few of the major ones. Office, we still have is deteriorating, even though certain markets like New York City, the office metrics are improving quite a bit. Miami as well is showing good return to office stats. But by and large, office, I still think, as we had talked about earlier, the delinquencies are expected to rise. We still have tenants rolling on pre-pandemic leases. So we still have a deteriorating outlook for office. For retail, that's when we did shift. So we had pretty much looked at the tariff impact and said we think that there could be some impact to the consumer, right, from tariffs, higher costs, the consumer's going to be stretched. So we did shift it from sort of neutral to deteriorating, just to be cautious about where the consumer may be heading. Hotel, we have as deteriorating as well. We're seeing some stress in the hotel sector just from the consumer and even business behavior, just being a little more cautious on spending for travel and business travel, leisure travel, and so forth. Multifamily is an interesting one. That's one where we actually shifted the outlook from deteriorating to neutral. So what we're finally seeing on the multifam front, after years of supply and new product being added to the market, the pipeline has slowed down for construction of new multifam. So if you look for the next 2 years, it should be a pretty good prognosis for multifam owners, at least from the demand side.
And what would change your outlook the most?
Yeah, I think the outlooks, if we saw a material change in interest rates, mortgage rates, for example, you could argue that would help refi activity, reduce delinquencies, spur some of the sales activity in the commercial real estate front. So that, and then the health of the consumer. If we start to see that the consumer is more healthy, job growth, that kind of helps and feeds into the commercial real estate performance.
Well, thank you, Bob, very much for your insights. And thank you all for joining us. If you have any questions or would like to continue the discussion, please email sfconversations@fitchratings.com. We'll also include a QR code that links to this address. Thanks for watching.